Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you, as always, for joining us as we go through this week's Market Carver of points that we covered on Monday's allocation meeting. We thought you might be interested in hearing about. So we got three topics for you. We're going to talk about private credit, the decline in new lows, and then an update on the Magnificent Seven, the theme of it seems like the market for the past 2 years, so something we've stayed glued to, and that's for certain. So I'll dive right into private credit. If you came to the Thirdlies, you heard a lot about private markets and how they've really reshaped capital markets over the past 10 years, and that is both on the equity or stock side, as well as the bond slash bank loan slash private credit side. And so this today we're going to talk about the private credit side because we saw an action by Moody's last week that downgraded three of the big players in the private credit space. So when we're talking about private credit here, these are large funds who make loans directly to companies as opposed to those companies issuing public bonds or publicly traded bonds. It's been an enormous growth sector, mainly because the banks, after the Frank Dodd Act of 2008 or 9, whenever those regulations were implemented, I think 2009, we really saw the banks pull back in the amount of lending that they were doing. And that created space for this private credit. And it's been a great place to invest. It is something that we have been increasingly using, but it has to be with a couple of caveats, as I'd call them. Number one, we have to remember that these are risk assets just like anything else. So we have to pay attention not only to the proposed or the prospective yields or return, but also, and maybe more importantly, getting that money back and the likelihood that we're investing in quality assets. And as Moody alerted us last week, these are not risk-free assets as they downgraded or shifted the outlook on three of the big players. BlackRock, KKR, Oaktree, all three have seen increases, both starting in the third quarter of last year and then the fourth quarter. All right, so there can be a lag here as Moody's analyzes the last public filings of these companies. But as you can see, the non-accruals are on the rise. When I say non-accruals, that means the loans that these funds have made not paying back their interest. So it'd be as if on your mortgage you were unable or haven't been making your mortgage payment. So companies essentially nearing or entering default, and those are on the rise here. I'm fortunate to say we're not in these three funds, but as a representation here on the industry, something we have to be very cautious in and making sure that the funds that we partner with have ultra sensitivity and great underwriting to make sure the loans they make have a high probability of both being serviced and paid back. So that's the private credit side. I will pass the ball over to Andrew for our stock update.
All right, thank you, Adam. So we've started seeing some volatility in the market. Last week, if you saw last week's Market Carver, the topic I discussed was looking at the 5% as we were approaching possibly a 5% decline in the S&P 500 and how that relates to the paper that I wrote last year called the 5% Canary and looking at the market implications of that. Well, during last week's trading, we actually did drop by 5%, just under 5.5%. And so in our Monday morning allocation meeting discussing, is this the type of market environment we start needing to maybe de-risk, decrease exposure to equities? What do we do now that we've dropped 5%? And looking at just beyond, looking under the hood of the market of what led to that 5% decline made us take a step back and pause and say, well, things actually don't look as bad as maybe they do just by looking at the pure performance of the indices. So the first chart I'm sharing today is looking at the individual stocks and how many of them are making new lows. So we have across different time frames, how many stocks are making 52-week new lows, 6-month, 3-month, and then 20-day new lows. And so the market itself, the S&P 500, began making new 20-day lows. When that first happened, about half of the large cap market stock index was also making a new 20-day low. So we were seeing a pickup, and a lot of stocks were joining the market, so to speak, and making new lows. But then throughout the week, trading last week, we saw that number decline. You can see the red lines going down, the orange, the green lines, the purple, the blue. All of the new low lists began to decline, even though the S&P 500 was declining itself, meaning we are not seeing stocks participating or confirming the weakness we were seeing in the broad market. And the reason we attribute to that, if we're trying to find a specific reason, is looking back to what helped lead to the strength in the market. And we talked a lot about it last year and the start of this year specifically, was those Mag 7 stocks, those big mega cap names, NVIDIA, Google, Microsoft, Apple, these huge stocks that really help propel the market higher. Is also, when the market starts to weaken, is what drove the market lower. So the next chart we can show here looks at three different ways we can look at the market. A regular cap-weighted S&P 500. We just talked about the S&P 500. That's what we're often referring to, the cap-weighted version. In the very bottom, we have an equal weighting, where all the stocks get an equal say in the performance of the index. And in the very middle, we have those Magnificent Seven stocks. Why this chart's important is the Magnificent Seven actually declined over 9% from its high, while the S&P 500 was down just over 5%. So we're seeing a lot heavier selling in those seven stocks, and specifically stocks like NVIDIA down 20%, stocks like Tesla down 50%, Apple was down double digits. We were seeing heavier selling in these really mega cap names. Meanwhile, the average stock, the other stocks that make up the S&P 500, were actually doing fairly well. In fact, on Friday, we had over 80% of the stocks were actually outperforming. The market was going lower. They actually were doing much better than the S&P 500. So these were all positive signs to us, saying that maybe the selling is starting to get a little exhaustive. Maybe we're not starting to see a little bit of constructive dip buying as people are looking outside of those Magnificent Seven names and starting to look for maybe value or dip buying opportunities there. And in fact, as we start this week, we are starting to see the market start to rebound, and we're now up a couple percent. Hopefully we'll see that continue the rest of this week. But these are good signs to see, and this shows a great example of why it's important to look at how the average stock is doing and not just looking at the overall index. We can get a lot of great insight to the health of a market, the health of a trend, and by looking and evaluating the breadth and the participation of how individual stocks are acting and what's driving a move in the broad market. And right now, we think that those mega cap names really are having a big impact. And so we continue to really stay focused on what's moving the market and to what degree.
Yeah, absolutely. And I love equal weight, something that you use often in here, and we certainly share from time to time. And thirdly, very, very important way to look. And sometimes I puzzle at how we got to the place where we have the S&P 500 in the cap weighted sense. That's the world we live in, but it is much healthier to look at your average stock. So very well put, Andrew, as always. So thank you. And thanks to all of you for giving us this time. As always, give you a reminder, if we can be of service, please give us a call, 800-928-4001, or scan the QR code and book it electronically. Thanks again. Have a great weekend.